Hello, everyone. Thank you very much for your patience. We're having a little bit of technical difficulty getting my panelists signed on. Are you guys able to hear me clearly?
Yes, sorry about that. We've had some technical difficulties, but we're actually on the phone, not the computer. So we apologize, but we're here.
Okay, perfect. Thank you. So I'm going to go ahead and get us kicked off. Thank you again, everyone, for signing on for today's webinar. My name is Corey Daharsh. I'm with Advanta IRA, and our topic for the webinar today is how to level the playing field on oil and gas investments. Again, my name is Corey Daharsh. My guest speaker today is Juan Espinosa. He is the president of SDM Energy. I've got both of our contact information here for the moment, and I will put this slide up again at the end of the presentation. So if you don't catch it now, you can catch it at the end. We'll also be emailing a recording of this webinar to everyone that is here participating, or even if someone signed up and wasn't able to attend live, you'll be listening to this recording later, or could find all of our recordings on YouTube, Advanta IRA on YouTube as well. So a quick overview of what we'll be covering today. I'm going to cover the basics of self-directed retirement account investing in Advanta IRA. Then I'm going to turn over to Juan, who's going to cover the actual topic of the day, leveling the playing field on oil and gas investing. He's going to explain the basics of oil and gas investing, SDM's process, what it looks like securing a deal, and we'll kind of case study a little bit of a previously closed deal as well. It does say wrap up and questions at the end, but I do want to encourage everyone to ask their questions as we go. I am using the questions box on the GoToWebinar panel. So our attendees will be muted for the duration of the webinar, but please use the questions box for active participation. I'll be reading those to Juan as we go, and we'll be addressing those questions and kind of having a more open conversation in today's webinar. So I really encourage everyone, if anything comes to mind, the smallest or the biggest question, please use that box to ask it, and we will answer accordingly. So just getting started with Advanta IRA. We're a self-directed IRA administrator. We've been in business for over 20 years. We've got about 13,000 active clients and just over $3 billion in assets under management. And each client of ours has a dedicated client account manager appointed to them. That is their go-to point of contact for any questions they have, investments they'd like to fund, or anything IRS and IRA related. So a brief disclaimer about Advanta IRA and my role here in today's webinar. We are a full service self-direct administrator, so we're not allowed to convey any tax advice, legal advice, or financial advice to our clients. So everything you see here is strictly for educational purposes. We're not endorsing, promoting any specific investment opportunity or strategy. It's completely up to the self-directed investor to do all of their due diligence and utilize their own team of attorneys, accountants, financial advisors, whoever that may be, before you decide when and where to invest your retirement funds. So what is a self-directed IRA? Well, in itself, it's an IRA account or a 401k account for that matter, health savings account or education savings account that you're allowed to invest into anything you'd like to within the IRS rules and regulations. A lot of companies out there that are fiduciaries or financial advisors say they have a self-directed product, but when you look into it, it really just is a pre-selected list of investments that they vetted out and they tell you you're allowed to invest into. That's really just coy marketing language. It is not a truly self-directed account unless you can go to them and say, hey, I want to invest into XYZ, and they have no reason to tell you no unless it's outside of the IRS's rules and regulations, which is what we're experts in. Again, we're not a fiduciary. We don't tell you, hey, this is a good idea, this is a bad idea. We just say, hey, the IRS will allow this, or hey, the IRS won't allow this, but you could structure it this way to make it within the IRS's rules. That is what a truly self-directed account is. So the number of assets you can invest into through a self-directed account is actually very vast. It's actually really limited what you can't invest into. So it's a really, really great tool for people that have their own investment strategies or maybe are investing personally into assets that they just didn't know beforehand they could also utilize their retirement funds for. I just briefly mentioned it, but there's a lot of different types of plans that can be self-directed. Most people have a traditional or a Roth IRA, or maybe have an inherited IRA from someone that's passed away that left an IRA account behind to them. Health savings accounts and education savings accounts can also be self-directed, as well as for small business owners or self-employed individuals, solo 401ks, SEP and simple IRAs. And a big bonus for solo and SEP and simple IRAs as of the past year or so is that you can now hold Roth funds or post-tax money in those SEP and simple IRAs. That's something you have been able to do with the solo 401k, but it's a big tax strategy for you to convert all these retirement investment dollars to Roth. Again, speaking with your own CPA or tax preparer, so that your income that you're generating grows completely tax-free and you don't have to pay taxes on the mountain that you turn your contributions into over the years of investing. So why do people choose to self-direct? I alluded to it there a moment ago. A lot of people find it as a new source of capital when they are already making certain investments that they can now use their retirement funds to bolster that investment strategy or that portion of their portfolio. A lot of people are getting fatigued with the stock market, so those fiduciaries may not be generating the best returns. I can't say promise because I know they're not allowed to promise, but they may lead you to believe that they're going to give you a X multiple return, and they're just not fulfilling that quote promise. So people are choosing to, if not move all of their funds, at least diversify into the self-directed avenues. And then the tax benefits. Again, the profits you generate in a retirement account are either going to be tax deferred, where you pay taxes when you distribute that money out of your retirement account later in life when you're actually retired. Or if it's a Roth account, you're really generating completely tax-free income from your passive investments through a self-directed account. It's really easy to get these accounts funded. I'm not going to take too long on these slides, but I want to really briefly identify it's not a taxable event to move funds into a self-directed account. It's a very simple process. With a transfer, what you're doing is you're taking an existing IRA and transferring funds directly into your self-directed IRA. All you do is fill out a transfer request form with the company that you're looking to receive the funds. They submit that to the company currently holding your funds, and it's usually facilitated within about a week's time. That is not tax reported or tax consequence. That's a complete IRA to IRA back office transfer where there's not even any reporting to the IRS done when you do it in this capacity. The other way to move funds that's very common is what's called a direct rollover. This does generate some taxable reporting, but there's no taxable event unless you're choosing to do a Roth conversion in the process of this. But what this is when you have a employer-sponsored plan, maybe a 401k, a 403b, a 457, a thrift savings plan, and typically you've left that job, so that fund is completely open and accessible to you to do whatever you'd like with it. You can initiate a distribution out of that previous employer plan and roll it into a new qualifying plan. In other words, your self-directed IRA account, and that's considered a direct rollover. You're allowed to do that as frequently as you want for whatever portion of the account you'd like. And again, it is reported to the IRS. It's reported on the distribution side with 1099-R, and it's reported on the rollover inside with Form 5498. So as long as the dollar amounts there match, you have no tax consequence for accomplishing this. We also allow for indirect rollovers, which is where you actually make that distribution payable to yourself first. You have 60 days from constructive receipt, meaning the day either a check hits your mailbox or a wire hits your bank account, to roll those funds back into a qualifying plan so that you do not have a tax consequence and continue the ability to have that money held in a retirement account for passive investing strategies. You are only allowed to do an indirect rollover once every rolling calendar year. So if you did one today on April 1st of 2025, you'd not be allowed to do another indirect rollover until April 1st of 2026. I alluded to this again earlier, but I just want to quickly go over the rules for IRA investing. Again, self-direction is a very broad stroke investment opportunity for every investor out there. The only way that the IRS limits how you can use these accounts are by labeling certain transactions prohibited, specifically investments into life insurance policies and hard to value collectibles like antiques, fine wine, artwork, anything that would be subjective in value. You're typically not allowed to hold in a retirement account. And the other aspect is that they label certain individuals close to you as disqualified persons. You're not allowed to transact with a disqualified person, meaning do a deal with them sitting on the opposite side of a table for a transaction. So I can't buy an asset from a disqualified person. I can't sell an asset to a disqualified person. I can't let a disqualified person benefit from an asset held in my retirement account. The disqualified persons are pretty simple to understand. It's basically the main trunk of your family tree. So your parents, your children, everyone up and down that main trunk, including any businesses that those individuals own or control 50% or more of. So that is the extent of disqualified persons. You may notice, as I have outlined here, brothers and sisters are not disqualified. Aunts, uncles, cousins, other distant relatives, friends, colleagues. Those are all people that you can transact with your retirement account. I've got a few examples here on what transactions constitute a disqualified transaction based on the disqualified persons rules. I'm not going to read each of these. Just going to kind of put this slide up here for a second. If you want a copy of these slides, you can also reach out to me via email. I'd be happy to share a PDF with you. It's very important with self-direction to invest with people you know. Always do your due diligence, as I alluded to on the disclaimer slide, so that you're very comfortable and confident that your self-directed investment is going to pan out the way you expect and anticipate it to. It's really easy to get a self-directed account open. Our application typically takes about 15 minutes to complete. We get the account open, get it funded within about a week and a half or so, and then you're ready to invest into whatever asset class you may want to. Again, today we're here to specialize on oil and gas investing. So I'm going to turn it over to Juan in a second. Before I do so, I really appreciate you participating in this educational webinar. We put out 2 of those a week. We also have a podcast called the Alternative Investing Advantage Podcast, and we have a blog you can find on our website about anything under the sun related to IRS rules, self-directed retirement account investing. So feel free to check out any of our educational content that may pique your interest. Without further ado, I'm going to turn it over to Juan. If you could just unmute yourself, I will keep an eye on the chat and let Juan take it from here. Again, please ask any questions you have in the questions box, and I will address those as Juan is presenting. Thank you.
All right. Well, good morning to everyone that is listening. My name is Juan Espinosa. I have been in the oil and gas business for quite a long time. I would say close to 20 years, especially in the Dallas-Fort Worth area. If any of you have ever received a phone call from a Dallas number, it's typically somebody calling you and wanting to sell you some sort of an oil and gas investment. Unfortunately, they're selling you something that makes them money, where they are going to be receiving a commission or some sort of financial payment. And these are people that have not been in the business. Dallas is quite well known for this. We were all a part of it. We all grew up in it, but after a while, the financial people kind of separated from the oil and gas people, and the oil and gas people remained. I had a company called Futura Royalties back in the early 2000s. I had 500 clients. I developed every single one of these clients over the phone, and we got some great relationships over time. However, I've always wanted to be on the actual operating side of the business. Coming from Colombia, South America, my father was and is still the main petroleum engineer who was responsible for some of the biggest developments in the country's history, starting with Caño Limón in 1984 and then Cusiana and Copiagua in the late 80s. These are fields that have produced over 1 billion barrels, with the B as in boy, that is. So what my partners and I decided we wanted to do after COVID was to get back in the business. If you guys remember, COVID brought oil and gas prices into negative territory. I remember we had minus $32 back in March of 2020. And we knew that this would be an elastic band type of movement. These markets mean revert. And by that, I mean, if NVIDIA goes up 700%, it'll probably lose a good amount of that money when we have more sellers than buyers. And at the same time, when oil was minus 32 in 2020, mean reversion tells us that we should have a price in the 60s eventually, which, if you remember, 2 years later, we were in the 120s. So there's many ways of being in the oil business, but what I'd like to cover today is 2 things. Number one, how to participate in oil and gas as an insider. I'll explain what that means. And secondly, how to use your retirement accounts to benefit and have Uncle Sam, pay a share of the Wayne State instead of taking a share of your own interest. So first of all, everybody's heard about oil and gas. You have famous examples, Jerry Jones being one of them with Comstock Gas and the Dallas Cowboys. You also have the Beverly Hillbillies, television program in the 50s. Jed Clampett goes out there and he's hunting rabbits and he shoots something in the ground, does not shoot a rabbit. All this oil keeps popping up and they move to Beverly Hills. Believe it or not, royalty owners like that, people that actually own the land where oil and gas is developed sometimes have, Beverly Hillbillies type stories. You have a lot of royalty owners that through generations have become extremely wealthy, growing wealthy off the land. However, you need an oil and gas company to go drill on that property. In this case, you have oil and gas companies that are in the business of developing and producing oil and gas. They put up their own capital. They take the risk. Oil and gas is definitely is the riskiest business in the world, but it's also the most profitable one. That is why Exxon has been, on top of the market cap for decades before maybe the dot-coms came up, and they're still in, the top 10, 15 companies that make money every single year for shareholders. Now, there's companies out there, and I call them fly-by-night companies since this is an educational webinar, companies that are not interested in making investors money. They're not interested in making themselves money. They're interested in making money off of investors' money. So what do I mean by that? You will get a phone call from somebody saying, hey, Mr. Corey, I would like to sell you an undivided decimal interest in an oil and gas well. It'll cost you $100,000, and if for some reason the well doesn't make oil and gas, then you lose your money. But hey, you will get a tax write-off from Uncle Sam. So a lot of high earners have done this throughout the years. We had many opportunities to do this. We were not interested in tax rates, but we were interested in oil and gas. So there are companies out there that will go to a field that they feel is undervalued, underdeveloped, and they will put money into the field. Corey, if you would like to, we could start with the VIBE presentation to show the audience without having any sort of, investment proposal, which this is not what we're here for. We're here to educate, but I think it would behoove us to look at VIBE's presentation on how I bought with my partners a field and what it takes to buy a field and what it takes to operate a field for profit. Is that something we could do?
Yeah, Juan, I just switched to the cover slide of the VIBE presentation. If you're seeing the screen, it's on the cover side right now. Just let me know as you'd like me to progress the slides. I don't want to do that while you're speaking or
Sure.
change the audience's attention.
All right, so I'll give you guys a little story here, a little background. So, it's after COVID. I'm itching to get back in the oil business. Like I said, I had a mineral company. We had 500 clients. We did very well. People did well, and we were selling the minerals that are perpetual. These minerals don't expire. So in oil and gas, you have two things. You have working interest and you have royalty interest or mineral interest. The working interest is the oil and gas company. They drill on the property. They have the lease. They're responsible for all the expenses, for all the maintenance. Then you got the royalty owners, like Jack Clampett. They just get a check off the top, off the gross, not the net, and they're sitting pretty. If something happens to the property, they don't have to pay for it. If the property makes money, they're the first ones to get paid. Being a mineral owner is kind of like being the Rolls Royce of the oil and gas business. And in every transaction in oil and gas, there's a mineral interest owner and a working interest owner. Working interest kind of tells you, the name tells you what it is. You're actually working. The mineral interest owner, he owns the land and he can take it easy. Mineral interest owners are smart. They've had many people come through their lands or, their parents' lands or their grandparents' lands in the past 30, 40, 50 years, 100 years in some cases, with prospectors that want to develop that land. So I'll give you an actual example of something we found in Louisiana back in late 23. This was probably September of 2023. And we met with somebody whose wife had enough of him having to drive from Conroe, Texas to Seminole, Louisiana, about 45 minutes from New Orleans in a place called Bayou Gauche. And it was I guess, 2.5 hour drive each way every single time something happened. So we were interested in looking at the properties, and what we saw was what we saw in many instances. We saw a field that had the potential to be developed, but we had an operator that did not want to spend any money. By that, I mean he would do the least amount of work possible to get by, to sell that oil and gas to a gatherer like Shell at the end of the month. So we knew that if we took care of this field, we could be in a situation where we could increase production. So I'll give you some specifics that you can see on that executive summary, Corey. this field was made up of 4 wells, mostly oil, not gas, and they were making roughly 33 barrels a day. We were able to increase that production into the mid 50s. Now I would say high 50s, and we acquired an additional well. So we went from 33 barrels to double that. However, this is what makes oil and gas so interesting. It's a puzzle. When we met the gauger, and I'll define the term gauger in a second, he told us that the entire health of the field depended on the water disposals. So a gauger is somebody like a hand that is working on your field. Let's say you have a big ranch, he's a ranch hand, and he makes sure that the ranch is being taken care of. So we have a gauger who lives 1.5 miles from the property. He has an alarm set to his phone. If ever the compressor goes down, he has to come out, whether it's 3 in the afternoon or 3 in the morning. He has to go back because we need to have our wells producing. So we have 4 wells here, and then we have 2 saltwater disposals. And I'm just giving you this background story as an educational story, because when those people from Dallas call you and they tell you about a deal, you never actually see the field. They might fly you to the field. They might, open a bottle of champagne and they'll fly you in a private jet and you pay $100,000, but you don't know what is really going on. We're not one of those companies. We actually want to operate and make money off the ground. In oil and gas, you have a buyer every single month. In our case, Shell buys our oil every single month. So we don't need to be selling to clients. We just need to produce off the land. So the way we produce off the land is we know our limitations and we know our upside. So to go back to the example, we have four oil wells, and then we have 2 saltwater disposable wells. What are disposable wells? Disposable wells are wells that dispose of water. You shoot a zone and you dispose of water instead of trucking out the water. If you have an oil and gas well and you're trucking out the water and you're producing a lot of water, you will not make any money. So to give you guys an example, the 60 plus barrels that we're making on a daily basis, for us to make 60 barrels, we're literally getting rid of 4,500 barrels of water. If we were trucking out that water, we could not even pay the bills. But because we have saltwater disposable wells, we can inject that water into the zones for literally no cost. The cost here is you do have to keep those saltwater disposals running. And in our case, every time we work on a saltwater disposal, it's an expense, but that is the best expense you can have. So this is another term. This is called the oil and water ratio. Here, we probably have a 97 or 98.5 to 1.5% oil to water, meaning that out of 100 barrels of fluid, roughly 98.5 will be water and 1.5 will be oil. That is why we have 60 barrels coming a day from Seminole, and we're producing, let's say, 4,000, 4,500 barrels of water. Every single time we get a barrel of oil, we are disposing of a lot of water. But this is kind of like going to the doctor. The analogy here would be, you know what you need to do when you go to the doctor or the dentist. You do a cleaning, you make sure you don't have cavities, you don't have root canals. It's simple maintenance, and that is why we have a gauger who lives in town about 1.5 miles, and when the compressor goes down, he needs to come out and fix the issue. Now, why do we have a compressor in certain oil and gas fields? Well, some of these wells, and I don't want to get technical, but some of these wells are wells that don't produce oil by themselves in terms of getting it up to the surface. So you have to have a compressor that has what we call in the business a gas lift. It's a compressor that pushes up the oil by injecting natural gas into that formation. That is why we call it a gas lift. And these are the fixed costs. And we'll get into those here in a minute. But if you look at the end of page 1, this field has an infrastructure where you have $1 million just in infrastructure. You have 400 barrels of oil, big oil tanks, and then you got water tanks as well. When we looked at this, people in the business would see that you need the infrastructure, because if you're a working interest owner and you think you can get oil under the ground, but you don't have the infrastructure, you have to write a big check. Not like you're in trouble because the oil will pay for it, but you have to write a check. So one of the things that is so attractive to us is that in this country, there are literally hundreds of thousands of wells that are what we call orphan wells. And an orphan well is the same thing that it means in, human society. An orphan is something that somebody doesn't want. And a lot of these companies walk away from wells that could be great producers, but don't have infrastructure, or the operator just doesn't know what he's doing, and they orphan them. The person that we bought this from, he actually made a deal with an oil and gas company called Wagner 5 years before, and he got some of these fields for next to nothing. We were the next buyer. We paid a lot more, and that's kind of how it goes. What I'm trying to get at is that if you're savvy and if you're smart and if you're really an insider oil and gas producer, oil and gas doesn't have to be, so expensive and as risky as people think. There are thousands of wells that you could pick up from the state for $100 if you have a good team of geologists, if you have a good team of engineers, like we do, that say, hey, you might want to pick this up. So that is kind of what we did here. Before we bought it, we did an exhaustive research. We looked at logs. We looked at production history. We thought we were getting a good deal. We think we did. And there are a lot of other fields like this. So what I'm trying to get at here with the audience is that oil and gas could be sexy, but oil and gas could be boring. And the more boring it is, the better, especially when you're talking about retirement accounts that you could buy an undivided decimal working interest, or you could buy a mineral interest and put it in your retirement account. Some of the 500 clients we had, a number of them worked through Advanta IRA and some other IRA custodians, and they took advantage of the tax-free opportunity or tax-deferred opportunity here. The way it would work for somebody, again, not talking about our own investment approach, but if somebody wanted to buy some sort of a working interest and put it inside of an IRA, then the IRA custodian would get the check directly into the client's account. Corey, if you would like to interject at any point with any sort of, IRA, clarification, or if I'm not speaking correctly, please do so.
Yeah.
So
no, Juan, there is a quick question, and you're really right on the nail of what this participant asked. So someone had asked, I bought a mineral deed last year. Is that the same thing as what you're offering or what you're describing? So you just mentioned it'd be a working interest investment, not necessarily a mineral deed investment. Can you clarify that a little bit further on maybe how these types of investments could be structured and what your strategy is for structuring them for the end retirement account investor potentially?
100%. So back when I had Futura Royalties, we did hundreds of transactions. I would buy the entire mineral interest, and then we would deed it out on an undivided decimal interest. So the person that asked you that question, he bought a mineral deed that can then be deeded to his name or his kids' names or his grandkids' names or his estate, and he can put that inside an IRA or outside of an IRA. When a well in that mineral interest starts producing, let's say Devon Energy is the operator. Devon will see a list of mineral owners that by law they have to pay. Let's assume this is a 25% lease. So all these mineral interest owners add up to 25%. They send out checks, and let's say that, Corey, you happen to be, a mineral owner with Devon that has IRA, Advanta IRA as a custodian. Like I was saying, Advanta receives the check, they put into your account, and then the beautiful thing about having your money in an IRA is that then your broker can call you and they can say, hey, Corey, you got $1,000. Why don't you cost average into the market? And you'll say, sure, buy me the NASDAQ, buy me the S&P. That's one thing. The other side of the equation, like I said before, there's always a mineral owner, there's always a working interest owner. Just remember, guys, the mineral owner has no cost. He gets paid from the top. The working interest owner bears all the costs, bears all the expenses, but he gets most of the lion's share. Typically, 75% of the profits go to the working interest owner, 25% go to the mineral interest owner. A transaction with a working interest owner could be structured the exact same way as with a mineral owner. The difference is that the custodian gets the check from the working interest owner and the mineral owner instead of that person. Now, if you want to do this outside of an IRA, you can, But if you have the capital inside of an IRA and you don't want to pay Uncle Sam, well, it makes a lot of sense, to do it inside of an IRA. So you could structure both of these. And like Corey said before, there's a lot of things you can put inside IRAs except, certain collectibles, and you cannot transact with parties that you're not allowed to transact with, like a wife or a husband or a child. In here, it's the same thing. You could literally be buying minerals and working interest owners, putting them inside your IRA. Now, and Corey, feel free to interject at any moment. What I'm trying to get at here with the audience is you've always heard the term smart money. And there's a smart money term in the oil and gas business. And there's a dumb money term. A dumb money term is somebody just wants to sell you a tax break. And hey, if you need a tax break, go ahead, go for it. That's not what we're here for. What we're here for is to make money every single day. Now, what makes oil and gas so interesting nowadays, when you add the technologies, that we have a company that does a lot of reporting for us called Greasebook. And Riley, I know you can't hear me, but maybe we could add an addendum where people that are interested could see how Greasebook works. Corey, Greasebook is an application that allows the gauger, that pumper that we talked about that lives 1.5 miles away from the field, to report what happened the day before. So, for example, yesterday in Seminole, we produced 54 barrels and we produced 16 3/4 barrels out of creation. We did about 70 barrels last night. Every day we get up and we check what we did the night before. This is something that is different from what it used to be 20 years ago. It's this whole Bitcoin idea of trust but verify. Like, we have seen so much fraud in every financial market, including some oil and gas, where you don't know if you're really getting paid what you're supposed to be getting paid. So when you're an actual owner of a field, you check to see that your pumpers are reporting the right numbers. And then those numbers should add up to that check at the end of the month that Shell, who is your buyer gatherer, will send you. So everything is extremely transparent. And that is the thing that we like the most. So when we bought this field, we knew we were going to improve it from 33 barrels to now we're in the, low 60s, high 50s, depending on what we can do with these wells, because we don't want to ruin our field. You don't want to overwater it. You don't want to underwater it. You don't want to overproduce it. You don't want to underproduce it. Having an oil and gas field, Corey, is akin to having a garden. You want to make sure you tend your garden right. You want to make sure you don't overwater your garden or your plants will die, or underwater your garden, your plants will die. The entire health of the field that we own in Louisiana is the water disposable wells. What is interesting is that after a year plus, we have not even touched any of the wells themselves. We haven't even spent any money on developing the wells, and they have different zones and different sands we could produce. But all we've done is we've maintained the garden. We've tended the garden with care, and you can see the results. We can, if you like to, we can next stage. Yes, go ahead.
Sorry, there's a few questions that have come in.
Sure.
Didn't to cut you off there. One, you were getting at there with some of the kind of nefarious aspects of the industry, and this question kind of aligns with that. How do companies like Vibe Resources ensure that they are not overpaying for oil and gas land acquisitions and that the land acquisition will be profitable? I believe you mentioned earlier making sure you have like a good team of geologists and so forth, but can you expand on that? And then I have a few other questions after you answer that here from the audience as well.
Well, the first question is a great question, and it goes to the heart of the matter. Everybody talks about OPM, other people's money. Well, it's really simple to overpay when it's other people's money, but not when it's your money. We don't have any investors. Well, I should rephrase that. I have one investor who's been with me 15 years. He's this farmer out of Iowa. Trust me 100%. He's like, you're in, I'm in. But we don't raise money to buy these fields. We buy these fields with our own capital, and then we develop them. And once we feel the cash is stable enough, we might open it up for people that are looking for cash flow generating assets along with us, and they get a monthly dividend. So one of the things that makes us very different, first of all, we are actually in the oil business. We're not promoters. We are not promoting anybody. We're not making money off of people's money. Now, if I buy something for A, at 33 barrels and I improve it to B at 60 barrels, well, the market tells me that this is worth C. And then I'm going to tell investor D, if you would like to own, a piece of our field and generate cash flow, this is what it will cost you. At this point, he can either buy it or not buy it. It's a simple market transaction. But to answer the question, for us, it's extremely important that we don't overpay. Now, we bought this field with our own money. We wrote the check in December of 2023, and we had a lot of things we needed to fix, kind of like a fixer-upper in real estate. And it was all our money, and we knew that we couldn't overspend. That's the difference between buying something with your money and buying something with somebody else's money. Now, in the future, if there's opportunities and there's people that say, listen, call me when you're going to buy something, I'll go in with you. So we will go in with them, and then we'll offer them the same type of deal we're getting. But there's going to be some sort of, I don't know what to call it, not a management fee, but maybe they do the standard third for a quarter in oil and gas. We haven't done that. We haven't even talked about that. But what we see ourselves doing in order to acquire more fields like this, Corey, that we know how to go in and develop them, put money into them, just like a fixer-upper in real estate, but that at the end of the day produce cash flow and you get good tax write-ups like the depletion allowance, which is 15%, plus you get to write off all your working interest expenses. So going back to that well that was the saltwater disposal, whatever money we put into it, we get to write it off. A lot of oil and gas companies have a very good tax situation because, they have a lot of things to write off. But this, at the end of the day, is not for write-offs. We're doing this for capital. We're doing this for money. And that is why I was talking about Greasebook. We see it day in, day out. And this is what's interesting. And your audience will really like this. You don't want to be flying blind. You want to know what's going on a daily basis. So my partners can tell you that if we see production drop from 65 to 70 barrels to 35 barrels the night before, alarms go off and we're like, what happened? Well, we might have a leak. So what do? We have a team of people that are on call. We call them. We have good relationships with them, and they get their butts over to that field because I don't want to be waiting 2 weeks and losing 35 barrels of production a day. That 35 barrels at $70 oil is costing me $2,500 a day. 2 weeks of that is costing me quite a bit of money. So we are very good at addressing a problem. Again, if I go into the dentist, you don't want that. I just came back from Colombia. That is why I bring up the metaphor. I have 2 root canals. And you know why? Because I didn't fix them, because I got lazy and I paid the price. It was suffering, pain. Well, in oil and gas, that becomes money suffering. And we cannot afford to go weeks or days without fixing what's wrong. So we typically will move very fast. Having Greasebook allows us to know to the moment in real time if we're doing well, if we're operating well, or if there's something that just broke that needs to be fixed. Now, oil and gas business, when it comes to people calling you over the phone, they are notorious for screwing investors. We don't call anybody. We don't have any investors except my rancher in Iowa. Would I be interested in getting a group of people that want to participate like us? Absolutely. Why? Because then I can buy more assets and develop them. That's it. Right now, we own 100% of it, but that's what we would like to do. And we can do this on the working interest side, and we can also do it on the mineral interest side. So I hope that answered that. And I know you had a couple more questions.
Yeah, there's 2 more series of questions that basically came in from 2 different participants here. The first series here is, how much is the ORRI? Who owns it? And then the second question from the same participant, what was the original royalty interest burden? And then after you address those, there's another series of 2 questions that came in from another participant.
Sure. And this example will elucidate how the business works and how savvy people do it. Typically, you want to have a decent royalty lease in the 25%, but in some cases, and some of these are old, so they don't go back 25%. In our case, in Seminole, we have a 12.5% royalty burden. However, the person we bought this from was smart enough to go ahead and give his wife an overriding royalty interest. So our total net revenue is 67%. It was 72%. So that 20, well, let's call it 73. That 27% is the 12.5 plus this person's override. But then we were introduced to somebody who didn't want to get introducing us into the deal. He didn't want to get a finder's fee. He wanted to be in the deal because he liked it and he knew what we were going to do. So that is how we gave him 5%. So every lease is different. Every deal is different. This is a 67% net revenue interest type deal, which means that when a dollar is produced, you pay 12.5% to the royalty owner before cost. You pay the override before cost. And then you pay your expenses, and what is left over, you distribute among your owners, your partners. The main thing that the audience needs to take away from this is that we own 100% of the working interest. So if we were going to, let's say, allow other investors that are cash flow driven to participate, we're still always going to be the largest owner. Therefore, we're the operator. We're the ones that are responsible with the state. And we're going to try to make this as commercially productive for us to maximize that profit because we're the owners. We're not coming into this putting 20 people together and saying, hey, we'll keep 5% and we don't care if 5% makes money or not. We made our money of the investors. No, we're doing it the opposite way. We're actually buying the whole field when we have the field developed. And listen, if nobody is interested in buying anything from us, that's fine. We like the cash flow. And we haven't even started developing the field itself. But we would like to build an oil and gas company where we're buying more assets. So the only way for us to do it is we reduce our ownership in a field like Semina. We take that money, we go into the next field. We rinse, repeat, do it again. I believe I answered the question about the burden, but there was a second part to that question. Would you mind repeating it?
The second part was, what was the original royalty interest burden? And then the investor that asked that question just also added, so you play a 32.71% override royalty interest. Those were two from the same person asking that initial question you just addressed.
Right. When you're an oil and gas operator, you want to have the least royalty burden. However, this is where you have to put pen to paper. We knew we had a 12.5% royalty burden, but we also knew we had a 14% overriding royalty burden. And that is just the way it is. And then the person that introduced us to the deal wanted to get an override on the deal instead of getting cash. We like everybody to be on the same side of the fence. We like everybody to have skin in the game. So yeah, this deal had, in our estimation, a little higher royalty burden that we would like, but you have to look at deals, deal by deal. It doesn't do me any good to have an 87.5 royalty interest with a bunch of, wells that don't make money. That's the thing that the audience needs to take away. Sometimes the royalty burden is higher. We're actively trying to buy that 14% override from the former operator's wife. I've been working on it for 6 months, and I probably will buy it. At the end of the day, I'll probably end up with 87.5%, meaning our partners. But we made a financial decision that we thought with the royalty burden, with what we paid and what we were producing, what our logs told us, what our team told us, we thought, hey, if we buy this, you could be making money. So we started with this producing 33 barrels. We've gone about 75, 80% on this field. We acquired another well. Right now we're producing 65-ish barrels, and the check is a nice check. And now that gas prices are coming up, it gives us the incentive to go look for zones that make gas. Like last month, we had a $10,000 gas check, and we're not barely producing any gas because gas prices were depressed. Now we're in the 420s. Now we're thinking, okay, so how do we go put some of these gas zones into production? That's the difference, Corey, between what SDM does at the operator level. It's kind of like giving investors a look behind the curtain. If any of your audience has watched this very popular show with Billy Bob Thornton called Landman, they tell you how the business works. This is the most profitable business sector in the world, but it's also the riskiest and it's also the hardest. So if you got actors that don't have skin in the game and don't own their own fields, I'm going to tell you what's going to happen. They're not going to care. They'll just walk away. In our case, we are not walking away. We have an obligation to the state to, treat this environmentally friendly, to produce it. If something goes wrong, it's on us, it's our money. And that's what makes it so fascinating, that there are hundreds of opportunities like this. I'll give you an example to the audience. Not more than 15 minutes away, a company went bankrupt and left all these wells. Well, the wells produced a lot, and we would like to take over that. Well, we can go get it from the state. for next to nothing and produce it. And we can go do the same thing we're doing. There's an insider's way, there's a smart money way to do this that people just don't know. They've never heard about it. And in a bigger picture type discussion here, if I'm an investor and I'm in my 50s, 60s, 70s, and I have been riding the semiconductor train, and I've been following Warren Buffett for 40 years, and Warren Buffett sells out of the S&P last quarter, and the news hits last week, then people are wondering, well, where do we go from here? Financials are overvalued. Technology companies are way overvalued. We haven't been this overvalued probably since 29 or 99. And what is undervalued? Natural resources. Gold is responding to the inflation signal. And you're seeing natural gas come up, and you're going to see oil come up. And it doesn't matter how many tariffs Trump is putting out, and it doesn't matter how many times they sanction Venezuela and Iran, oil is still holding on. And you mark my words, based on the work of a couple of very well-known investment banks like Adam Rosenblatt's one, we have peaked in the shales. And no matter how much Trump talks about drill, baby, drill, and adding 3 million barrels per day to the supply, you cannot BS geology. Geology can't be lied to. I believe we're going to have, $100 prices in the next 12 months and possibly $7 gas. So think of my situation here. If I'm producing 65 barrels a day and I just get a 40% bump on my paycheck, well, I have no reason to sell. The reason to sell is for me to acquire more. And I just want to make sure the audience understands the difference between selling for the heck of selling or selling when you have something in mind, which is what we have.
All right. So I'm looking at the time. We're right at 1 o'clock, but I know we started a few minutes late. So we'll give it about 10 more minutes if you're okay with that, Juan, just to make sure that the audience gets kind of the full length of the intended presentation here.
Sure, definitely. Are there any more questions, Corey?
Yeah, I was about to address the next series of questions. These came through, again, from the same investor, just asking a series of items. If you buy a working interest in this, you said that the owners are responsible for expenses. Does that mean that the IRA will have to pay anytime there is an expense? An example, the IRA would need to have cash to pay these. And then furthermore, so is this actually buying a piece of that field? So the IRA would need to pay property taxes, et cetera, each year. And then a follow-up question from that same person, how long before it would start producing income? So I'll let you address that. I've seen the taxes in those types of situations handled a few different ways based on the investment provider. So how does SDM kind of handle that?
Corey, tell me again. I'm writing this down because this person's asking some great questions. Tell me there's 3 parts. The first one is tell me again.
The first one and the second one are kind of intertwined. If you buy a working interest in this, you said that the owner is responsible for the expenses. Does that mean that the IRA has to pay these expenses and have cash on hand?
Right.
For example, like property taxes, et cetera, that are due on an annual basis. And then the second real leg of that was how long before it would start producing income. I'm assuming that's relative to a working interest investment.
Right. Okay. So I'll answer that. And this is a great question for the listener in the audience. We don't like doing what we call a cash call in the business, which means, let's say the saltwater disposal needs to be reworked. Then we don't want to call that person and say, hey, your share is X, our share is Y, you own 3%, we own 30%. What we would typically do is once somebody becomes a partner of ours, we will discuss and say, this is how we like to do business. We're going to keep a reserve in the account in order for you not to get a cash call, and everything will be transparent, just like any other business would. That would be number one. There are property taxes. We found out the hard way this year. We can prorate those and deal with the state. We're very good at dealing with the state. And the answer to the second part is, how long until you cash flow? Well, it depends. Like in this situation, and we like getting into deals that are cash flow because we immediately, start seeing dividends. Now, if we have to rework them, then we know that we could always rework them with our own cash flow coming from that particular property. In this particular property, if I left this open, they'll get a check 30 days later. But we're not looking for anybody. This is educational. But if somebody were to reach out to us, and we'll give you that information Corey, Riley, please make sure Corey gets it at the end. If somebody were to be interested, the thing to do is to talk to me. It has to be a fit. It has to be two heads that think as one, because we're not interested in getting people that don't value what we're doing out here. Now, if we get into a field that we are picking up and it's not producing yet, it might take us 90 days before we start cash flowing it at the most. We're not going for exploratory fields. We're not interested in dry holes or big elephants. We're interested in singles and doubles. We feel that if we can have a mutual fund approach and add wells as we go, wells that are undervalued, underproduced, operators that don't have the capital, operators that don't want to do this, that's our niche in the industry. I'll give you guys an example of something that didn't work out, because some of these don't work out. We reached out, we found out that our gauger knew a gauger in the bayou in Louisiana, and the guy was getting old, and he had a couple heart attacks, and he wanted to get out of a well, and we told him we would operate it. Well, for 6 months, he had, he was very emotional about his well, and he decided not to do anything at the end. So you have to pursue, wells and fields that you like, that you think have upside, but there's also an emotional part of this. The oil and gas business, whether you believe it or not, is very emotional. People get attached to their fields, to their wells. It's a matter of pride, and we're starting to see that ourselves. We do things in a more obsessive type way. I think we're a little obsessive about what we do, but that is what ensures that we catch mistakes early. It's like they say in the market, let your winners run and cut your losses short. Well, here, if I have a leak, I have somebody out there. If I have a problem with Shell, we get on the phone. We have a field in Mississippi that they made us cut the lawn. They changed the law from 10 feet from the wellhead to 100. Things we got to do. But oil and gas is here to stay. All the green investments, BP Green, all that scrapped. We are back to oil and gas. Everything we have, everything we drive, everything we wear, it's mostly made out of plastics that are made out of oil and gas. So if you're going to be an investor in oil and gas, there's ways for you to do that. You could buy Exxon stock all day. You could get a 3% dividend. But I'm not interested in that. I'm interested in being an oil man and taking advantage of Uncle Sam's loopholes as well. And that is why the discussion with, an IRA custodian is so timely. Plus, we're in a situation where people out there don't know what to do with their money. They're being eaten away by inflation. I don't care what they tell you. Inflation is not 2.8% or 3.2%. People know better. People are smarter than the government gives them credit. And this is an opportunity for you to take your financial assets and be responsible for them without having somebody tell you 90 days out on some sort of investment letter, oh, by the way. No, you can see this daily. And if somebody were to become my partner, they call me every day and they could see what I see every day. We're trying to grow a company here, but we're trying to do it from an insider perspective on the smart way. I hope that makes a little bit of sense, Corey.
No, very much so. Very much so. All right, so I've got one last question here from the audience, and then we'll go ahead and wrap up. We're getting close on time, and I did put up the slide on the screen with both of our contact info. Someone asked earlier, and I don't believe I've checked on this with you yet, Juan, but the slide deck from today's presentation, typically people do request it. Someone already has in the chat. I usually share a PDF version of my slide deck if someone emails me afterwards. Do I have your approval to share your side, or people could reach out to you directly for your slides as well?
100%. And I want to make two comments real quickly. Somebody sold my phone number like a year ago, and I had 100 spam calls a day. I had enough. So I will have to update that phone number, number one. Number two, I don't believe we put a disclaimer on the slides, but again, we're not selling you anything. We're not pitching anything. We're just kind of telling you, hey, there's different ways to make money in the market. And when it comes to cash, it's not just real estate. And real estate, in my opinion, we're in Florida right now. It's very expensive. Oil and gas is an undervalued asset. A lot of the things that we do is we do a lot of oil and gas intelligence because we follow people that are in the know, that are investment bankers. And we're not just going to go buy a field because we make a little bit of money on it. I mean, what is the long term of this? Are we in a 5 to 10 year run? I believe so. For us to get back to what natural gas prices are doing in Europe, which is $13 an MCF, boy, we'll make a killing. Same thing for oil, in the hundreds, 150. Adam Rosenwald believes we're going to be in 200 oil, and that's just the price of the shale speaking. So anyone is 100% encouraged to reach out to me to have conversations. If they do call me, they're never going to have somebody putting pressure on them because I own this thing. I make money every day on this field, but I would love to share the opportunity with like-minded people. That's the main thing. But this is fun. It's a hobby, but that it makes money. And I'll tell you something that is great. We're working on an app that kind of tells you what the production is on a daily basis. You can go into it, but it dings. And we've had some people tell us that it's a great conversation starter, when they're at dinner with friends. So it's not just about money. People that are listening to this have already made money, Corey. They're just trying to grow their money, but also to be interested in how their money works for them in something that just no one is doing this. I challenge the audience to show me somebody that is doing what we're doing because they're not. It is too much work. That's how I'd like to finish it, but it's a lot of fun work. Again, we'll provide that new number. Corey, if you want to, I can give it to you now so that you could update it. And I believe the rest is pretty accurate.
I can't update it over the PDF here, but if you just want to say it out loud, this will be on the recording, and everyone that's here live will be able to take it down.
Yeah, I'm going to give you two phone numbers. I'm going to give you Riley Vance's phone number, who is one of our partners. His phone number is 214-649-9538. And then my personal cell phone number is 786-213-8453. 786-213-8453. And again, none of this is, an offer for solicitation. There's no private placement memorandum. But if we were to get somebody involved, I'll always do things right. Going back to the Futura days, we did everything by the book. Everything is legal. But at the end of the day, it's up to an investor. Look, are you looking for cash flow? Have you made a lot of money in your tech stocks? Do you not know where to put your money next? How do you take advantage of a market that is undervalued? That is what we're personally doing with our capital. And if anybody would like to pursue that train of thought, they're 100%, encouraged to call us. I would say call me first, and then, or Riley can send a message to me. If I don't answer, leave me a message.
All right. Well, perfect. Thank you so much for all of your expertise and insight into this industry, obviously. Again, if anyone wants to reach out, Juan just gave you his phone numbers here verbally, and all of his other contact information is here on the screen. You could reach out to myself if you didn't get that number taken down, or reach out to me or Juan if you'd like a copy of today's presentation. Thank you all again for participating. And again, thank you for your patience at the beginning from a little bit of the technical difficulties and delay to get us started. But hopefully you've obtained some great information and insight here, and we look forward to having you again next time. Thank you, everybody.
Hey, Corey,
have a great rest of your day.
Can I say one more thing, Corey?
Sure.
Since we didn't cover the whole presentation, I encourage the audience to go through it. The last slide, we actually have a breakdown of what our costs are so that people see where the money goes on a monthly basis. This is something that just no one will do. So this is full transparency, what we have to pay, and then you just put in your numbers. Hey, what if we increase production? What if we develop new zones? What if oil goes to? What if gas goes to? So I encourage everyone that is really serious about their capital and just the percentage of their capital that they wanted to work in oil and gas with people that are actually doing it. I encourage them to reach out to us. I apologize for the technical difficulties and we couldn't cover all the details, but we could do that on a personal phone call. So Corey, thank you again, and thank the audience.
Of course. All right. Thank you, everybody. We'll see you next time.